Okay, good afternoon, ladies and gentlemen. Welcome to this final session at the AMA Theatre at Financial Services Expo. I'm going to provide a little bit of context by way of where we are in terms of the broader market and a little bit of the economics around the housing and mortgage market at the moment. Look at the advice review. I'm going to talk a little about how I think the seconds market might play out post-Mortgage Credit Directive, and then I'm going to look at the real future of what advice might look and feel like as we go further down the track and what's actually important in the mortgage world today and tomorrow. But I want to reiterate something that was said in the panel session earlier, that the fundamental issue facing us is still the fact that we are not building enough houses in this country. Supply is being outstripped by demand continually, and we have, in no less a way of saying it, a 1.5 million deficit in houses that's built up over the last decade. And this is a fundamental issue that we are going to have to address at some point, and this government is going to have to address at some point, or else I think the pressure that's going to be applied by Jeremy Corbyn and his cohort is just going to escalate, because clearly when the first question he asks at PMQs is about exactly this topic, you can tell where the Labour Party is liable to start pushing buttons quite hard, because they know they've got fertile ground to go at here. That's going to give us, as an industry, issues, because we're going to be in the spotlight as an industry, because the public doesn't differentiate between house builders, mortgages, whoever's in estate agents, whoever's involved in the chain. It's just how they solve their housing needs. And the biggest problem we have, of course, is that the number of houses in stock at estate agents is at the lowest point historically over any understandable period that we've had. Why? Because what's actually happened is that we've gone through a long cycle of people looking to move house, having a look, couldn't find anything they liked, therefore not put their house in the market. Therefore, that has gone into a little vortex of it getting worse and worse and worse, and therefore we actually reached the bottom, I hope, where people begin to have to speculate to put their house in the market without having found one themselves. It's only when we take that flip again that the market will begin to pick up, and we have to talk about that to people in order to achieve that position. So, what I think about mortgage and mortgage advice at the moment, well, across the UK, everybody talks about average house price increases and the UK mortgage market. It is not a UK mortgage market, and we have some fundamental differences because we have a series of regional housing markets, and even within regions we have differences within those regions. And you can see in this change in house prices relative to the 2007 peak, you've got massive regional disparities, where in London and the outer metropolitan area we've seen significant house price inflation, but across large tracts of the north of the country and the west of the country we have not seen house prices come back to anywhere near the 2007 peak. That gives this disparity is because we still have a situation where jobs were created in the southeast, everyone wants to come and live here, and that drive of a large vibrant economy south of that line from the Severn to the Wash is driving things in a very, very strange way. So unless we begin to change that conundrum, we're going to continue to have some fundamental problems. And those fundamental problems then manifest themselves in things like this, where the first-time buyer house price to earnings ratio is in a very, very different place now from even the 2007 peak, where London, the outer metropolitan and outer southeast, we are back past or at that affordability peak in terms of earnings versus price. Now, of course, if you're sensible and live in other parts of the country, north, we're not in that same disparity, but of course the issue is that whilst we've got low interest rate, there's still opportunity, but in a normal world, this doesn't look comfortable around any of these areas. And then we look at first-time buyer mortgage payments and percentage of take-home pay. This looks really positive in comparison to any peaks we've seen where we've got into trouble before, where most those of you who've got grey hair like me can remember what happened in the late 1980s, early 90s, when all of this got too far out of line, and then what we saw in 7 and 8, and it looks okay, but this doesn't look okay if interest rates go back to 5%. If interest rates go back to 5%, those mortgage payments go back above that 50% peak line. And therefore, the need to keep interest rates low is driven by a lot of different things, and we'll come onto that again in a little minute. But what we also have is people intervening in this market to try to control house price inflation. So we've seen the Financial Policy Committee come in and change by introducing LTI caps in the conventional market, and it's looking almost certain that we'll see the same thing happen to the buy-to-let market as we go towards the end of this year. But we've also seen that come in, and we thought initially when that was brought in at 15% above 4.5 times, would probably not actually do too much damage in the market until Barclays suddenly found themselves in trouble. And what's actually happened is that the big banks who've got private banking arms have got themselves in trouble first because their private banking clients who they will lend to at significant multiples of income soak up that 15% number very quickly, and they have to close off the outside market in order not to breach their requirements. That has a domino effect then into other lenders, because other lenders who are prepared to lend in that have got a bigger volume of activity coming at them than they might have otherwise. So we've seen Santander putting caps for first-time buyers, TSB introducing caps, and Skipton playing about with this in order to limit their liability and stop getting themselves in trouble with the Governor of the Bank of England. I think the debate is what happens next. And I still think that what we've seen is this come in and take the lid off London, but it stopped a development in other parts of the country. And it is this fact that this is a one-size-fits-all approach which doesn't match the positions across the rest of the country that's giving us some of the current difficulties. Another area which I think the commentators are perhaps getting wrong is an issue around this debate between gross and net lending. So everybody's panicking that because gross lending's going like a steam train again, so if you look at where we've been in the last 3 months, it's got an effective run rate of 240 billion, if you believe the numbers. So we're 20 billion a month at the moment, so that grosses up to 240. The market this year is going to come in probably around that 215 billion figure, up from the 204 last year, well up from the 143 billion. That's beginning, but the government sees that growth, and the Bank of England and Treasury see that growth as being inflationary. The interesting problem is what the real thing that's probably inflationary is net lending, that growth in total outstanding balances, because gross lending is just a proxy for money moving about all of the time in remo terms, not product transfers, but in remortgage terms. And therefore, what we've got is remortgage coming back, and we're seeing that uptick in gross lending, but that isn't what drives inflation. It's net lending that will normally drive house price inflation. And we see net lending has been relatively static all the way from 2010 to 2015 today. So we're not seeing that net lending figure growing in anywhere near the way that should be contributing to house price inflation. But what you can see is net lending continuing to escalate as unsecured is coming into play, as well as secured debt. And the thing that's causing concern about increasing base rates is that as base rates come back and that total debt on the back of incomes not growing is a real worry, which is why I think we'll continue to see, and people have started to talk about the fact that will we see a base rate rise? Well, certainly not in 15, but when in 16 will this actually come? Because certainly with inflation where it is at the moment and unemployment going suddenly in the wrong direction, there's an argument to be had that says that keeping this lower for longer is a necessity in order not to stifle the retail economy. And this is where it begins to really show, and we've seen house price inflation come back, although net lending hasn't gone up. And it would only be net lending, real growth in the value of money lent into the market that should grow this. So therefore, the only thing that has been causing this is the volume of cash purchases. And it's that cash purchase issue that certainly drove most of that house price increase in London and the outer metropolitan southeast area. And therefore, my argument, my hypothesis would always be that what we're seeing here is more a function of cash coming into the market rather than anything that's happening in the lending environment. And therefore, when governments try to intervene or policymakers try to intervene by trying to control lending through tools of controlling LTI or LTV caps, then they're liable to have unintended consequences, which doesn't actually deal with the core issue. But I don't see exchange controls coming back anywhere in the near future in order to try to limit gross and house price inflation. So where are we now in terms of what's expected in a marketplace? Well, I think the interesting challenge we have is around this affordability issue. And when we did MMR, the mortgage market was very clear about committed expenditure and basic essential and basic quality of living costs being the component of affordability assessments. What unfortunately we saw in the initial work that was done by most lenders' risk departments and compliance departments was build affordability calculators that hardwired every piece of consumer's expenditure. What we are now seeing is some reining back of that and some common sense coming into play, so that discretionary expenditure is now beginning to be dealt with in a much more sensible way. This is all going to take time, and I think we won't see the real fundamental changes on this until we get through to the middle of next year, once the FCA opines on how lenders are dealing with affordability in their thematic review they're doing at the moment. But the other problem is transitional arrangements, where we've seen a reluctance by most lenders to deal or use the provisions that are there in the rules in order to give flexibility to the marketplace. And it was always the intention of the FCA that we should still have a free-flowing market. But unfortunately, in terms of both lenders' capital positions and their appetite for risk, we've not had that opportunity or seen that opportunity being afforded over the last 12 to 18 months. But I do expect this to change as the desire to grow their mortgage balance sheets takes hold, and we still see that continue to become a big issue as mortgages are a very profitable part of any bank's balance sheet in the current environment and future. What I want to turn now to is the advice market review, which the FCA conducted and gave their publication. And if anybody in the room has not actually read it, then I commend it as a very good read. Any business which is in the world of advising on mortgages, and any individual who's involved in advising on mortgages should read that advice market review and look at the good and bad practice that is set out in there. So it's one of, I think, in terms of as a detailed piece of work, one of the best reads FCA has ever produced in advising advisors about what good and bad looks like in their job. It's not often I say that about the FCA. The debate I would have with them as to how robust some of the research is that sits behind it, but the practical examples they give in there in an attempt to move the market forward is very good indeed. One of the things they were very clear about was that particularly direct lenders were having particular problems in differentiating between information and advice. And I understand that, because one of the big debates we had as we were going through the MMR debate was my view that there had to be greater clarity between the various component parts of the advice journey. So that information element sits in one space, that fact find sits in another space, the recommendation sits in another space, the application is a distinct space, the underwriting is a distinct phase, and then finally the administration is another phase. The rules didn't reflect that at all and kind of bundled it all in together into a single process. And what we saw as part of this review is the consumer doesn't want to tell the truth because they're worried that if they give something away in fact find, it will damage their ability to get the loan on underwriting somewhere else. And that's a problem for us as an industry, in that good advisors have to unpick that somehow and pull that out from the consumer in order to make sure that the application they submit is complete and meets the lender's tests. But this is a problem we have about a process which is push-pull, and we're selling a product or advising on a product that is customer demand-led, not the other way around. The other problem lenders have is that when they're doing this information piece, and somebody walks into one of their branches, they very quickly get caught into probably moving from information to advice because they have a very limited product set. And as soon as they begin to talk about one of their particular fixed rate 5-year products, it's actually almost moving into recommendation. Whereas intermediaries can do that quite well, talking about a range of product sets and a 5-year fix, and as long as you don't ever get to the point of mentioning a particular lender, you've not moved out of providing information into the world of advice. But it's having that clarity of thinking that causes the problem. And therefore, what we're seeing is a whole load of direct distribution arms struggling to do this information. Therefore, they're bolting everybody into the advice process very quickly because of their fear of being caught out in mystery shopping, such as was done in this exercise. The other thing to remember is that this exercise that was done off the back of 121 mystery shops where they either videoed or recorded what went on. Therefore, they've got very good tangible evidence of exactly what was said by who, to whom, on both sides of the table. I think it's fair to say that the project team did say to me that the worst examples of things that were said in these interviews are not in the report. They were so bad they did not dare even publish them. So I think we can accept that if you go back and look at the investment thematic that was done 3 years ago, where the advisor said to the person, well, I can tell that you're balanced just by looking into your eyes, we didn't get too far away from that in some of the interactions that went on in this study. The other part is that customers don't get advice. They think that any interaction they have with the person is advice. And they walk away from that thinking that they've had advice, whereas we tend to, in our job, break that down into different components. And we probably have to be better at signposting when we're doing different parts of the process in order not just to meet the regulatory requirement, but to help the customer understand where they are in the process and why they're in that dialogue. And that's a difficult thing to do because it's kind of clunky. And it doesn't feel comfortable when you're signposting the customer, we're moving from this bit to this bit. But it's probably required in order to help them understand why they're in that part of the interaction in the process. The one area they were quite caught up on, I thought was interesting in this report, was on monthly payment versus term. So we all thought, reading the rules, that there was this real requirement to try to get the term as short as possible in order that the least cost came out to the customer and the overall cost of the mortgage. It's got logic when you think about it. But what came out of the thematic work was a broader view from the regulator that actually a good debate around what's not just affordable today, but what might happen if interest rates go up, is important in terms of having a dialogue with the customer about what the term of the mortgage should be. So suggestions in this report that says the customer might have walked in asking for a 25-year mortgage, but once you sat down and looked at their budget and what money they genuinely had available, it's not necessarily wrong to end up saying, well, actually, to give you more headroom and actually to allow you to live the lifestyle you want, a 29-year mortgage might be more appropriate, as long as you appreciate that over the term of the loan that will cost you an additional £25,000, £30,000, £40,000. But as long as that's transparent and that discussion happens, it is the conversation that the regulator actually wants to happen. And it's about a consumer-focused outcome that matches the consumer need, not order taking in terms of everything's a 25-year mortgage as long as you're under 40. And that's the other part of the debate around where we get to in terms of age. Interest only also, they were astonished that everybody appears to think the interest only market is closed. For some consumers it is, but there are now more and more lenders coming back to the market with various degrees of what might be acceptable interest only for their risk appetite at this point in time. Clearly in the direct space, for certain lenders it is closed, but in the intermediate marketplace, as long as you know where to look, there are some decent products out there. Price might always be the issue. I think the other challenge that sits in this place is about interest movements as well. Because we have some challenge around how we talk to customers about when interest rates might shift and how much they might shift and what impact that then has about whether they do a fix or a variable or a discount or a tracker. It's all of these things that have to come into the discussion and debate about how the consumer ends up in the right place with advice from the advisor about what is best for them in their needs and circumstances, not their pre-thought idea when they walked through the door saying, I've seen that Woolwich 2-year fix and it looks pretty good to me because I've done my sums already and it comes in a number that's less than I'm paying today. That's not, and if you then just fulfill that, that's not advice. In fact, it's the worst thing you can do under the terms of what the new contract is under MMR. The other area is that they had certain concerns around is debt consolidation. Firms not collecting enough evidence to justify the recommendation, and some firms, they said, have a weak policy and controls. Now, the good firms understood their responsibilities and were able to make judgments as to the suitability of doing this. And it's not just doing risk warnings disclosures, but actually taking the customer through the real impact of this on their total cost and on their short-term impact to their, I call it profit and loss account, their income and expenditure. The other part is firms need to record all of these and probably treat them as more high-risk cases and be reviewing possibly all of them in terms of advice quality checking, because these are seen by the FSE as being high-risk cases in terms of the world that we live in today. And they're almost saying, in terms of this world, that a debt consolidation case should not always be seen through as a refinancing case, and that the discussion has to be with the customer about other options as well, about whether the customer should be actually going back to some of their creditors to ask for forbearance, or whether actually they need to think about an IVA or some other structure rather than securitizing the debt. Because they're still concerned about whether adding that debt into being underpinned by the house property is the right way to go in all cases. And it's not to say that it's wrong, as long as the customer understands the risks of what they're doing and the way that they're doing it. But the general feeling was that there was not enough information being gathered from the customer about the debts that were being consolidated in order to justify the recommendations or the outcome that was achieved. Perhaps not even the recommendation, just the product that ended up being out there. Turning now to culture, governance and oversight. This has probably had the least debate about what's in here, and I think is probably the most important part of this. Because this is about what type of checking do you do as a firm of advisors? And if you're a one-man DA, what kind of work is being done to test that you're in the right place? And they said that in most firms there's not enough challenge in there. And what they mean by that is that there might have been some checking that says the file is complete and appears to match up with the product that's come and what the customer has said. But what they found was, in a large number of the cases where they mystery shopped and tracked it all the way through to the case file, there were significant mismatches between what the customer was recorded of having said and what the advisor had recorded on the file. They are therefore endemically worried that there is a gap between what the customer needs are and what they come up with, which is not mirrored in the file. Therefore, they're encouraging firms in their quality checking to not just accept what comes in by way of paper, but to do some validation by going back out to the consumer to check that the detail on the file actually matches that customer themselves and what they said in the interview. That is a huge step from where most in the industry are today. And that quality assurance and what MI is available is fundamental. And I see there should be a lot more cases where if individuals are observed in an interview, that case is tracked all the way through in terms of file checking as well. And that might be something that firms have to consider going forwards. The other part they found was that when they then looked in at a couple of firms as to those areas where firms had also flagged there was weaknesses, they found that actually feedback was given on the particular weakness that was identified in the file, but rarely were files around that pooled of similar type to see if there were more systemic issues with that particular advisor. So there's issues around how supervision is. The most emotive part of the report was probably the statement around networks. And I like to characterise this in a number of ways, in that if I look at the report, I find three particular statements in the report where clearly, in different cases, it's probably the ones where the three cases they found where bad advice was given. Looking at what's written in the report, it's clear that all of those were actually indirect lenders. That's not to say, therefore, that gets the networks off the hook. Because what they're saying in here is that when they talk to networks, there's a mismatch between the people who run the network, who actually have the regulatory responsibility, and they're not close enough to understanding the consumer at the sharp end. They delegate that to the principals of their AR firms, or their appointed representatives, to effectively still run themselves as independent businesses. Now, I think that's a fault of where we've gone over the last 10 years since mortgage regulation, where a number of networks have been out trying to sell themselves as the cheapest possible, lightest touch to allow you to do your own thing. Now, I don't think that's sustainable in the long term, because ultimately these network heads have the responsibility to the regulator for the advice that's delivered to the consumer, not the AR firm that sits underneath. Therefore, I think there's going to have to be a rebasing in some networks of that relationship. And that's what the regulator is looking for here, a rebasing of that relationship. Therefore, I think we're in a difficult period where some networks may have to look at the costs that they're taking from their ARs in order to get them a place where they can afford to do more than they're currently doing. And so the strengthening of governance and oversight arrangements to mitigate some of these risks of poor consumer outcomes is a core part of what this market review was all about and concluded. So I think there's lots of clear guidance in here as to what is expected in the new world we live in today. I think the big challenge then is to actually think about how a second charge market comes into this environment. Because a second charge market, if you think about how far this first charge industry has come since 2004 on the adoption of mortgage regulation, as we've gone through TCF, MMR, and then this type of review that gives very clear views of what good advice looks like, we're a long way away from the second charge market as it currently exists today in a consumer credit environment. And most of the firms are currently doing what they do on a non-advised basis. So the requirement to step up and work in the same regime is huge. So in the landscape of the future, firms have to make a decision as to whether they're going to add, if you're a first charge firm, seconds to becoming irrelevant into your relevant market, or if you're a second charge firm, whether you're going to bring firsts in. And certainly Keith Hale yesterday, I know, passed comment on whether a second charge firm can purely advise on seconds and whether that becomes too clunky or too disproportionate, because anybody who is looking at a second has to probably consider whether a remortgage or further advance is more appropriate. And if they're not going to have that type of advice, there'll be a host of consumers sitting in that seconds only space where the advice might have to be, actually, you need to go away and look at this first before you come back and talk to us about this. That's naturally an uncomfortable place for a seller, a salesman in any environment. But in the first charge market, you need to decide whether they're in or out of scope. And if they're in scope, you have a choice, because you either do it all yourself using a sourcing system that helps you get there, or you have to partner with an expert. So a master broker or another broker or a second charge broker who can help you. But the decision you have is a range in this whole spectrum, because you can exclude them from scope and still refer, and that's okay, but you probably can't take income for doing that. Or you can partner with a master broker who will either take that customer away once you've decided that a remortgage or further advance is not appropriate, and they do the whole work, or you can do it in partnership where you pool the information backwards and forwards and you still do the advice, using them almost as a packager in terms of that relationship. think the challenge for everybody is who to pick, who do you trust, who fits with you and your business model, and who meets your values in terms of judgment. Therefore, you're going to have to do due diligence and evidence that due diligence in anybody that you decide to partner with. And decide the process for referring. And is that going to be a very warm handover, which is you introducing, or is it a very cold handover just by passing on a name and address? So about that process, about that consumer process, and then what feedback you expect in the process as well. And I would recommend that anybody who's going to do anything like that gets that tied down contractually as well. There should be terms of business agreements and contracts that pull all that together, so there's clarity. From the regulator's perspective, their expectation is very much that the consumer understands exactly who they're speaking to at what point in time about what. So it's about doing what you say on the tin and being very clear about that. I want to touch briefly on protection, because a fully protected mortgage is probably the only way to go in this current environment. And I view it's always good advice to fully protect, but of course then that brings protection into the issue of affordability. Now, I have a view that says that the only thing that's absolutely compulsory in terms of affordability in a mortgage is the buildings cover, because that's the only thing you probably have to have in order for this to fly. Contents cover is entirely discretionary. You can choose to have it or not. You probably want it. But then life cover, critical illness cover, or income protection is entirely discretionary. So should that come into a lender's affordability calculation? Probably not, unless they genuinely believe that this is a fundamental part of what they want, and therefore if they're doing that and have a fully protected mortgage, then they should probably give a lower rate because it's fully protected. But that's another debate entirely. The debate everybody has to have is being good at this. And I think the challenge for us going forwards and looking at the advice world tomorrow is whether you actually decide you're going to do this yourself or whether you pass it to a protection expert to do it on your behalf. And certainly what I'm seeing is given the time pressures and the kind of task pressures that are now on mortgage advisors, the move to giving this to a specialist to do it is becoming a better way of getting both market penetration, good consumer protection, and actually sharing income. But that's a choice you have to make as a business model, but it's certainly one that I think will push forward more and more as we go through the next period of time. There is going to be a debate about weighted or enhanced premiums, mainly because of a court case called Plevin, which will come to fruition in the next few months. That court case has been decided. The Ombudsman and the FSE are currently opining on how they want to define that into the marketplace, and we will get guidance on that in due course. But that will limit the ability to enhance premiums. And we have to think about whether we want to be in that place or not in terms of providing good customer service. And in terms of all of this, the new ESIS only requires you to show the very specific commission you earn on the mortgage transaction. And it's the commission that you earn on the mortgage transaction. That gives you a problem, because if you're earning commission from that customer in lots of other places, cases like Plevin make it very clear that you have to have somewhere total commission disclosure, or you will fall foul later on of somebody coming back through a claims management company and saying, I didn't know this man was earning so much money out of me. Therefore, you have risks if you don't have somewhere full commission disclosure to the customer. Turning now to wider issues. The FCA is going to be undertaking an advice market review first of all. This is going to be possibly a huge piece of work where they look at whether they can solve the problem in the pensions market by changing the way and producing simplified advice. I'm very much of the view that actually most consumers are compelled to talk in sensible terms about their finances about 5 or 6 times in their life, and that's normally when they're moving house or want to do something fundamental in restructuring their mortgage. In very few other occasions do they feel compelled to actually get involved in a proper conversation with anybody. Therefore, I think that they should be building any future advice model more around the housing transaction and the mortgage transaction and the work that you guys do than perhaps some of the more esoteric stuff that happens in the upper end of the advice market, which is somewhere different. And even for those people reaching retirement, where the house is going to be a large part of their funding of their future need, we need to find a different way of doing this. So I'm going to be very much pushing in that review to see whether or not the building blocks of advice need to be restructured in a way which works better and involves this part of the market to a greater degree. So I think the way we've gone down this specialist route is probably not worked in the best interest of the consumer, particularly we have a rule book which is totally focused on conduct issues. So it's separated into investments and pensions over there, protection over there, and mortgages here. Consumers don't think or work like that. consumers come in with a need and a problem that needs solving, and it's normally linked to where they are in their life stage. And we need to totally throw away that rule book and start again about how we do advice based on people's stage in life, not on a particular product that we happen to be flogging to them that meets part of a need they may have at that point in time. And we have to change the way in the landscape that we think about that. But that advice market review will be the chance we have to really draw breath and think about that. The challenge is that the Chancellor wants that review completed by the next budget, probably around next May. Therefore, the team that's being put together at FCA and Treasury to undertake that piece of work are going to have to hit the ground running and be very good on that. I think the other part is that the crying need for lifetime and equity release is only going to escalate, and the need for advisors in that marketplace is only going to increase. What has grown from around an under £1 billion market to grow almost, I think it's going to get close to 1.4 billion this year, I can confidently see being a £5 billion market by the end of this decade. I've always said that the equity release and lifetime's time will come, and I think we're reaching the point now by necessity where it is going to happen. That therefore leaves me with what type of advisors do we want to be? And I think the fact that you're sitting here, coming to an event like this, and sitting in this room means you actually are already there in terms of the middle point, because you're fundamentally interested in your industry, fundamentally interested in your business, and fundamentally interested in the consumer. The problem we have is that we have all the people sitting in regulation who somehow don't believe that. And my job is to help to transform that thinking. And I think by focusing on the consumer at the right time in the future and thinking about what type of advisor you want to be and what you want to service and what you want to do and how you meet consumer needs, both directly and through the use of technology, we can move forward again into a new generation of advisors, helped and grown by you, because I view this as an exciting sector to work in that will give us a bright future for tomorrow. Thank you for your time. Thank you for attending. I hope you found that a little bit enjoyable, and I hope to see you all again here next year. Thank you.